If you're a fund manager, family office, or deal syndicator, this episode shows how a $1 billion PE firm uses low leverage, deep alignment, and operator DNA to protect family legacy and beat returns, all while founders actually want to sell to them. All this and more coming right now. Here we go. Andy, welcome to the show, man.
Thanks a lot, Ryan. Great to be here. Really appreciate you having me and looking forward to chatting tonight.
Yeah, me too, man. So you've built a lot of things from all the way from Goya Foods through your family and the company that your grandfather created to a $1 billion AUM firm at AUA. So, I'm curious, given that history with Goya Foods, how do you institutionalize a family office mindset into a scalable private equity platform just without losing alignment? Well,
yeah, for us, it's all about alignment, right? It starts with alignment. We focus on alignment throughout the entire ecosystem of our investment process. We start with our contribution and our investment in the fund and the deals, right? So a lot of times you'll see PE funds investing, 1, 2, 3% of GP capital into the fund. We have been 15 to 20% of all the capital into our funds. So we are truly aligned with our GPs. I believe that the best way to make money in private equity, and there's a lot of ways to make money in private equity, is my bucket of cash and my partner's buckets of cash growing alongside our LP's buckets of cash. Next, we only invest in family businesses. So we require them to roll equity back in with us. So they're fully aligned with us on the outcome of the deal and making sure we're all rowing in the same direction and focused on a good sale of the business and 3, 4, 5 years after we invest. And then next, we also have a team. We focus a lot on the operations of these businesses, and we have a team of what we call value creation partners, what some other firms might call operating partners. All of those partners of ours are investors in the fund. When we deploy them into specific portfolio companies, they invest extra money directly into those companies. And then they also, if they sit on the board or in the C-suite, become a small piece of the management option pool. And like most private equity funds, right, we obviously have a management option pool for everybody who's in the C-suite. And sometimes that goes down below the C-suite and have bonus pools for everybody when we sell the business. But just trying to continue that alignment and everybody focused on the right thing for the business and creating the best thing we can do, best processes and improvements to have the most successful exit possible.
Wow. So that really underscores, I would say, for those listening to us, it really underscores how utilizing relationships with key operators can be immensely powerful in this business. Would you agree?
Without a doubt, especially in the businesses where, look, we're investing in good businesses. Don't get me wrong. These families have done an incredible job and they're great partners, but they've never seen the best businesses, right? They are usually internally grown family members and people who have been in the business for a long time, which is great. But, they've never had somebody from Colgate-Palmolive or ConAgra or name Mondelez, whatever, come in and show them the best processes and stuff. And if we can tweak things here and there and increase margins by 2 or 3, 4 points and accelerate growth by, 3 or 4% a year, it makes a big difference at the end.
Brilliant. I'm really curious since, going from traditional family office funds and institutionalizing that, many family offices have tried to do that. So I'm curious, what would break first when a family office tries to behave like an institutional GP? What have you seen looking back and assessing it?
Yeah. So a lot of times what we've noticed is family businesses, when they try and institutionalize their family office or try and become investors, instead of just running their own business that they've grown up with or built themselves. They don't realize it, but they've built a very good team. So they go out and try and, do this somewhere else or build a family office and think they can do it from their operating company or without the right professional help to get it done. And that sometimes, goes wrong. And when you take a step back and you look, what made them successful in their own businesses and where they have the most expertise, it really is first of all, their expertise, obviously, and their drive, but also the expertise and the knowledge base that they've created around them in, their partners, right? Their partners being employees or family members or whomever, that really understand everything about that business and that industry and can drive it to its optimal performance. And, we have seen, and I have seen, even friends start to launch a family office, and they have their divorce lawyer or their trust and estate lawyer handle contracts and things of that nature. And it's helpful to have the best people that you can doing what you're going to do, especially if it's something new that you're going to branch into.
Brilliant. And also how expensive it is. This is a very different world in going from family office and then evolving into more of an institutional side investor.
Absolutely.
But what's cool about what I love, and this is something that I love about you, is you're able to take the soul of your family and your family office and bring that into the firm. And that's what I love about the transition from the family office into institutional investor is when you do it right, I would guess, I haven't done it, but you have, when you do it right, you also bring that the soul and the values of your family and all that with it, rather than just being, a standard, I don't want to use the word chop shop, but a standard deal.
Yeah, no, yeah. Look, you're absolutely right. We look, I grew up in a family business. I love family businesses. I wish all families could hold their companies in perpetuity, but that's just not facts of life, right?
That's right.
And we've built a very good reputation, starting with my background and working in family offices and with families and family businesses my whole life. Now the team has had a ton of experience. We've done over 30 transactions with families. And, one of the nicest things is every time we've sold a business, those families have become investors in the fund because they like what we do. They like how we've treated them. They understand we do what we say we're going to do. We treat them with respect, and we want to learn from them, right? Like, as I mentioned, we're not buying broken businesses. We're buying good businesses. We're just helping them tweak around the edges and build past where they are able to build. And we learn a ton from them. But that kind of, being able to say, I've sat in your seat, and trust me, my family has its own family dynamics that are, one for the books. So I've seen a lot. Can't say I've seen everything, but I've seen a lot, and it's helpful. And as I mentioned, there's a lot of ways to make money in private equity. The way we've decided to do it is bringing that family culture and helping these families have a successful, painless, or, fun transition out of their business, and hopefully fomenting and strengthening the culture and the family feeling that their business has. So even when we do sell together, even if it goes to a strategic, that legacy will last even longer than if they had sold it before.
I love that. And, when it comes to institutionalizing or building a lot of that culture and trying to figure out those operations, governance is a big, important part, regardless of how you got there, regardless of AUM. Governance is important in this sector. So I'm curious, from your opinion, how did you guys design governance to protect the long-term control of capital?
Yeah, look, we are control players, right? So as I mentioned, we have our own family dynamics in my family. So I know that we need control in these businesses to get the outcome we need. So focusing on maintaining control, that was important to us. But I like to use an example. One of our earlier investors was a great family, immigrated here from Taiwan and started a great food business. Peter was a second generation. He took the business over from his parents and was a great CEO. Took us look, we're a little different sometimes. We're not playing in a lot of auctions. We do play in some auctions, but we got to know the family over 2 to 3 years. And eventually everybody decided they were ready to do a deal. And we did a deal. And, he struggled with it openly. And we had him speak at one of our annual conferences. And one of my favorite, quotes he said was, I knew I was giving up control, but I never felt control throughout the entire hold. And that was a deal where he ended up staying on as CEO when we sold the business to the next sponsor. And he ended up rolling more equity into that deal than the entire business was worth when we bought it. That's how good he did and how good we did together. But that's important, right? To us is making sure you treat your families and founders with tremendous respect. And then, it's simple. It's not rocket science. I'm not Elon Musk or Jeff Bezos putting a rocket into space, implementing a strong board of directors, or we're implementing a strong board of directors. And that's usually a big gap in a lot of our PortCos. And obviously, like I said, I'm an operator, but more importantly, our value creation partners, dropping them in and letting them do their work really unlocks the most value that we can do. And again, all done with the help of the families, with the families being involved in all different levels, right? To either transitioning out or being mentored to take bigger positions. But that's what's worked for us.
Okay. So helping them to not feel controlled, even though on paper, you do control the company, setting up a board of advisors, and then using your value creation partners or whatever name that anybody wants to give it, but really just making sure that they have oversight, support, respect. That really goes a long way with working with family-owned businesses as far as closing the deal and making that. So it sounds like your governance framework really helps to not only sustain that family vibe that they're probably used to, but also helps to create value. Would you agree?
Of course.
Yeah.
And once you get the value creation partners or other outside board members in, you start opening up connections and connectivity that these families had never seen, top to top selling with Walmart, with Kroger, with HEB, with Wegmans, with, Trader Joe's, all the big players, and finding, continuous improvement people when there's food manufacturing, all those things that some of them may have never thought of before or how to tackle really unlocks a lot of value. So, really using that connectivity that all the operators and the partners have really amassed over the past, 30, 40 years has been a big driver for us.
Brilliant. So, we talked a little bit about alignment, and especially with the family dynamic, and I love that. But in your opinion, what does true alignment look like between operator DNA and possibly your LP expectations? Because you got to support, the leadership team there, but you got to support your investors on the other side. What does that true alignment look like?
I think LPs are happy with the amount of personal money me and the partners are putting in, right? 15 to 20% of a fund can be significant. As you said, we have $1 billion or so under management. Fund 3 will be, part of that number. So it all drives that true alignment. And then for me, it was just making sure I had the right people helping to operate the fund with me, right? So I have 3 founding partners with me, Steve, Dave, and Kais. Steve and Dave have been working together for close to 30 years. Kais joined them about 20 years ago. And then we all joined forces about 15, 16 years ago. And it's been a great partnership ever since. Then, we loop in some of our stronger investors and we create what's called an LPAC, as I'm sure most of your listeners know, right? And our LPAC isn't just our biggest investors. We find, the LPs to join the LPAC that we think would be most helpful to us in running the firm, giving us advice, especially if there's any conflicts on deals or things of that nature.
Yeah.
And, making sure we have a strong investment committee for acquisitions, dispositions, anything we need to do. For us, the investment committee is all 4 of the partners, except only 3 of us have a vote. But it has to be 3 of us, has to be unanimous to have any major, decision made on the acquisition, disposition, refinance, and just want to make sure everybody's heading in the right direction. That's the goal.
Yeah. And so it just sounds like you and your operators that you work with, your founders, sounds like you just take all of the touch points that affect LP experience and reverse engineer to say, how do we make sure that there is no friction in that and that the LP experience really starts to align, and then those expectations we're talking about really start to come forward in a positive way? Is that what I'm hearing?
That's the goal. Yep, that's the goal, obviously, right? You want as little friction as possible. Sometimes there's more friction than others, but yeah, you try and plan as well as you can.
Yeah, that's definitely the business we're in for sure. So how do you decide when to use personal capital versus fund capital when you guys have deals come around?
Yeah, so if it's anything that fits within the parameters of the fund, it will be a fund deal. If for some reason we decide not to do it, then we just don't do it. If it's something that doesn't fit the parameters of the fund, smaller or a much longer hold period, I would send it, or the team would send it over to the family office, and sometimes it works the other way. The family office sees something that says, hey, AUA private equity might invest in this. We're not going to take a look at it. We're going to send it over to the fund. Again, it's all about alignment, but my family office is looking at investments that are usually in the 30 to 50 year time horizon. Nothing like that in the fund, right? We're looking at 3 to 5 year time horizon. And again, all in the fund is consumer packaged goods, businesses doing 10 to 50 of EBITDA. So if there's anything in the food, beverage, or pet sectors that's in that kind of strike zone, we would never touch it with personal capital. It would either be a yes or no in the fund.
Awesome. Yeah. And that also makes sense. So, you hear a lot about family offices, and a thing that most people don't realize, and you can keep me honest here, Andy, but what most people don't realize in the family office space is they actually hunt in packs. So a lot of family offices talk to other family offices and they know each other. And so family offices are well networked. And so it sounds like, and this is where I need you to keep you honest, it sounds like because you have those roots from the family office side, that you still have that network to say, well, this doesn't work for this vehicle, but maybe there's a family office, maybe it's, your family office or one that's friendly to yours. And you can see that when you get into operators like yourself, who I don't know if there's probably a better term, but hunt in packs in a good way, and that you can bring that forward to say, well, our PPM or our LPA only says we can invest in these particular ones. This doesn't fit, but you know what? I still think this is a good deal. It's just I can't invest in it, but these areas might. Are we hitting on some true notes?
Yeah, okay. No, look, absolutely. And look, you'll hear the term club deals and syndicated and right. Family offices like to make sure that there are other smart investors doing deals alongside of them. And so even some of our investors and LPs, right, we will send them deals when we'll see a deal doesn't fit our strategy, but I know what that family is looking for and what they're strong in, and I'll send a deal to them and say, hey, this may fit your strategy, and they may take it down themselves. Because we have about 50% of our LP base, when you extract the large GP commitment, is families and family offices, and the other 50% is traditional institutions. So that's another reason why some families like investing with us is they get to see deal flow that's outside of our sector, that's brought to us, that we can funnel their way. And again, we're always talking to bankers and stuff, and some families will tell us, hey, we're trying to find XYZ if you run across it. And then when we talk to bankers, we'll say, hey, I know some people who are looking for XYZ. If you see it, let me know. And then we'll just connect them. But yeah, especially in the family office side, that is definitely a thing that happens without a doubt.
Yeah, this is what's so cool about the transition from family office. That's why I said you get the soul, you get the connections, you get the network effects. And then you can bring that DNA into family offices. I love it. Now, given, Andy, that you take control positions, typically is my understanding. So when it comes to that, what's your underwriting filter that facilitates that in the lower middle market? I wonder if you can walk me through a little bit of what you look for when you're control investing in the sector that you are.
Yeah. So like anything, we first look for the quality of our partners, right? We spend a lot of time with these families. We want to make sure they're ready to sell, right? I have talked families out of selling their business at that point in time because I truly just didn't think they were ready. I've been right most of the time where they haven't sold the business. And a few times, a few years later, they've come back to us and said, you were right, but we're ready now. And we've been able to do a transition with them. But getting to know the families and our partners through, a nice diligence process is important. And also getting to know the employees, their suppliers, kind of the whole ecosystem through the due diligence process is important. Then, top level growth rate of the business. We're looking for, a minimum of 8 to 10% growth if we can. And hopefully we'll be able to grow that to 12 to 15%. We like to look at sectors, where is the food industry, beverage industry, pet industry going? What, like anything, right? High tides raise all boats. So strong tailwind makes your plane, your boat go faster too. So if we can find sectors that are growing faster and we can invest in those sectors. So we do like healthy, better for you. We like high protein, high fiber. We like snacking, kind of taking a look at what, GLP-1s have done to the food industry and understanding how food companies are adapting around that. Sometimes we'll like a sector and won't take the risk on these high moving brands, but we will take that risk from the manufacturing side. So we'll become co-manufacturers in that sector. And we've done that successfully in the meat stick business and the protein bar business. So that's really how we kind of dive into the filter.
Okay. And so quality of the partners you're investing in, or maybe quality, alignment, all the above. Growth rate needs to be within a certain amount. And then the sector growth, like you talked about, the tailwinds, those are some of the elements that you explore when you are looking to do deals. Yeah.
Correct.
Did I miss anything, or we got it?
No, that's it. And look, and if we are going to do a brand, we'd like to invest in a brand that has been established for many years, right? Like I said, there's a lot of ways to make money in private equity, and there are people who have made a lot of money in high growth, early stage brands. That's not really what we're doing. But if there are brands out there that families have held for 30, 50, 100 plus years, we're happy to help them, transition.
I love that. And, speaking of transition and moving through those deals, I'm curious, I've been meaning to ask you, so how do you guys then structure your downside protection when you are writing concentrated checks?
Yeah, so we usually do about 9 deals per fund, and obviously diligence is key. We worry a lot about making sure that the value creation partners are up to speed and involved in the diligence. We have a playbook created before we close the deal. We prefer businesses with higher margins and lower margins. We try and invest in recession resilient businesses and kind of build that 30-day, 100-day, and 1-year plan long before we get in there and close the deal. So hopefully, through the diligence with, some of the big consulting firms and other things, getting these plans done and written before we go in. Now, as most of your listeners know, what consultants write and what comes to fruition in reality is very different, but it's good to have that plan and understanding. But we do like to, have our value creation partners and me and my partners dive in deep into the diligence and have a clear playbook of what we're trying to achieve before we close the deal so that we can hit the ground running. And if there is going to be a transition in the C-suite, try and identify some people before that deal gets closed, have them be part of the conversations as to what can be done, and really try and do as much front loading so that when, check is cashed, we're running down the street, not just kind of trying to organize ourselves and figure out what's next.
Hey, if you're finding value out of this discussion, could you do me a huge favor? Could you just take a second and hit that like or subscribe button? It costs you nothing, but it tells the algorithm that this is valuable information, and it helps us to get it to more people. Thank you. You're incredible. Now let's get back to the show.
Yeah, brilliant. So it sounds like high communication, high margins, and then high execution speed. Those are some of those things to say it's baked into just how we operate. If you have the opposite of those three, this also adds to potential or increases the probability that you realize downside risk within a certain PortCo. And so you're just saying how we operate in itself. I mean, there's other legal stuff that we contract, but just how we operate helps to cover our downside risk. Is that what I'm hearing?
Yeah. And look, sometimes when you get it right, things move faster. So for instance, in Western Smokehouse, partnered with a great family, and we all agreed what we thought we could get done in 4 to 5 years, laid that out in a plan, and actually achieved over 90% of that in about a year and a half. Right, the business just took off. The management team was stellar. The operating partners did a great job. The investment thesis was spot on, and we started getting inbound calls. And we looked and we said, "Look, we've achieved 90+% of what we thought we'd get done in 4.5 years in a year and a half, and we sold that business in less than 2 years." At about where we thought we'd sell it in 4 to 5 years. So sometimes that works, right? And having all that pre-work done early and having the team set up and having everybody dropped into place even before you close really makes a big difference.
Yeah, that's brilliant. That leads me to, so we covered different things: alignment, value creation, and downside protection. And so for your post-acquisition, your cadence for operating, what's your perspective on how you create value? Once we close the deal, we inked up, we're good to go. Now we're the owner of this new PortCo, or at least controlling interest. How do you create value from that point forward in through your private equity deals?
Yeah, well, like I said, hopefully we're doing that before we cut the check, right? We evaluate the C-suite, we bolster them, we transition them or exit them, we figure out what the right thing is going to be, and the family and our team all comes to an agreement. Now, sometimes the agreement moves one way or the other. Like I mentioned with that deal with Peter Lee and Water Lilies, we thought he thought he was going to transition out in 3 or 4 years, and he ended up becoming an amazing CEO. And like I said, stayed on and is still CEO with the next sponsor 2-3 years later after we exit the business. And that business continues to do great. We stay in touch with him, 1, because he's an investor, and 2, because he's a good guy. Yeah. And it's important to us to make sure our businesses do well after we sell them, right? But it's important to have that evaluation of the C-suite done even before we cut the check. We want to make sure we get the board up to speed immediately. So figuring out who we think would be the right board members to jump on and start that diligence work and diligence the business with us. And then as soon as we close and the check does get cleared, they're activated immediately. And of course, just making sure everyone's aligned, to a 3 to 5 year plan, what the goal is, from the start. And for us, it's important to have, 3 to 5 initiatives that we start early on that I like to say are, small enough to win and big enough to matter. And if you can get those done, that starts really getting the family excited about what these changes can do. And it's really an amazing thing. Because there is some obviously skepticism from these families as to how good we will really be able to complete what we say we do. And like I said, when you have one of our operating partners, Mike Tracy, walk in to a plant that every family member thinks is running stellarly and say, I can get 15 to 20% efficiency out of this plant without any significant capex. And 3 months later, it's running 18% more efficient. That moves the needle. That moves the needle when Maria Fernanda Mejia comes in and says, these are the people we're going to talk to increase sales. I know you're growing at 10%, but next year we're going to grow 13%. And build that so it grows 15% the next year. And that happens, and you start seeing the top sales communications, and you see the customer and consumer communications at shelf. Really, the families and the partners, everybody start getting excited. And, it's great having an aligned team, but having an excited and aligned team is even better. And that's what we try and get done early.
All right. So adding the energy, excitement, and helping to create that alignment with a 3 to 5 year plan. And then, like you said, small enough to win, but big enough to matter. I absolutely love that, man. So now I'm just curious, with all of that said, how do you institutionalize culture across all these different portfolio companies and family businesses and the way they like to do things? That is no small job, my man, but you're pulling it off. I'm curious how you pull that off.
Well, first of all, thank you. And look, I have a great team, right? And it starts with the 4 founding partners, Steve, Dave, and Kais, and the junior team that we built, Charlie, Brian, Tripp, Jordana, Scotty, everybody has been great part of this. But we try and learn from the culture that's within each of the family businesses that we partner with. And most of them have a common thread. It's trust, it's respect, it's faith sometimes, and they all point to trying to have the best results. And so we start there, and we, as I said again, using that phrase, pick battles that are small enough to win but big enough to matter, to matter, and just kind of try and build that family culture. And each family will have individual things, but a lot of those common threads are in there. And above all, just ensure that growth mentality is shared across everything. Right? We're here to grow these businesses, and I see it in my family and everybody. Right? One private equity company will do one bad deal, and families will say that's every private equity company. They're coming in, they're gonna fire us. We're all gonna lose our jobs. Uncle Billy's gonna be fired, right? That's not what we're here to do. We're here to take your company and grow it, and making sure everybody's on that same page. How that we can really grow this business and get that growth mentality shared across everybody is the most important thing for us.
I love that you said that, because a lot of people in, organizational behavior, a lot of business, those type of people, what they do is they really talk about the value of growth versus fixed mindset. And there is quantifiable evidence. This was a long time ago when I was in college, but quantifiable evidence that says when you have, especially in your leadership stack, but throughout your company, when you have a growth mindset that you're talking about and that you guys have institutionalized, the growth mindset, as you said, above all, that adds significant value to any company, whether it's the direct company or the private equity company that's managing the direct company. That growth mindset that you talk about, and the fact that you're talking about it, shows it starts at the top, and helping people to understand, like, hey, there's going to be great moves, there's going to be missteps, all things considered, but no matter what, it's not acceptable to not get better. It's not acceptable to not learn, and it's definitely not acceptable to not grow. How am I doing so far? Would you say that that's woven into your DNA?
That's it. And that's throughout the organization, right? And that's getting everybody from the man or woman on the line to the CEO on the same page, right? That everybody can help us grow, right? If people on the manufacturing floor understand they're important to making us grow and helping us grow, that creates a great culture. And everybody talks about different ways to motivate their workforce. I want a happy workforce, right? Everybody talks about comp and vacation days. All that is part of it. But the outcome is I want somebody who's happy to come to work. And when they go home and their neighbors are like, what's your job like? They're saying, you should come work here, right? Because recruiting is hard sometimes. And if you have a happy workforce that can help you get good quality people in all levels of the business, that's important to us. And that's, one of the things that helps us maintain that family culture, making sure that all the employees are as happy as it can be. Now, look, it's still work, right? For a lot of people, I happen to love what I do. Not everybody loves what they do, but if you can find something you love what you can do, it's always better.
I love that. Yeah, for sure. And I could tell you're a great operator. I was like, where were you when I was just graduating college? I would have loved to work for you. But, when it comes to private equity, and a big part of that is leverage, right? You hear about the LBO, and there's many other leverage strategies that you either may or may not know. But for you guys, I'm curious, how do you guys think about capital stacking and leverage discipline in today's high-ish rate environment? How are you guys handling that?
Yeah. So look, we've never been high leverage type players, right? So first of all, we're working with families, even though we take control, we're working with families who have probably never had any significant leverage on the business. And while we have control, we respect our partners, and we have actually closed deals with zero leverage on them and have done well. Nice. So we take that into account. But we like to be somewhere between 2.5 and 3.5 turns of leverage. That's where we feel comfortable. Sometimes if we get in and we're a year into the hold and we really see growth trajectory, we'll take that up to 3.75, maybe 4. But so rates affect everybody, obviously. Lower rates in our industry is good, but we are not 5.5 turns of senior leverage, 3 turns of mezz, and some other stuff on there. We're not leveraging a business, 8 times. Which again, a lot of ways to make money in private equity. A lot of people have made money in private equity levering businesses that way. That's not what we do. That's not how we do it. And again, a lot of it comes from, look, my family business doesn't like leverage, right? So, families don't usually like levering their business. But if we can get the families to understand it is a tool, not a horrible thing, it can help everybody. And we've been successful in getting families to understand that and partner with us. And we're 2.5 to 3.5 turns. That's usually what we like.
I love that. So 2.5 to 3.5 turns, or 2.5, 3.5 times the EBITDA is the leverage amount that you use in the deal. And that, for those that may not know it, that's actually very conservative. So anywhere less than 4 turns is actually traditionally quite conservative. 4 to 6 is maybe middle market, and then anything above 6 is quite aggressive. I would think. Maybe you would disagrey, but those
no,
are.
I agree. In our industry, absolutely. Yeah. You talk to family businesses, they're like, 2 turns is crazy, right? But
is it? Yeah.
Yeah. But that's right. Like I said, hopefully we can get everybody comfortable, and we do respect the families, right? So if we can make the underwriting work now it comes at a price, right? You got to give things up. And we tell people, if you want the business to run certain ways after we close, that may affect the sale price, but understand if that's what you want, we'll try and get it done.
Brilliant. I love that. So leverage is a big part. If you want to be conservative, that's a good place to look. If you want to be like Andy when you grow up, but obviously you want to consult your attorney and everybody before that. A big part, and this one I think gets overlooked by emerging managers, and it is nailed by some of the best, and that is communicating with your LPs or your investors. And a lot of that, like obviously there's tasks and there's process and all that through investor relations and whomever, but it also starts with philosophy. And I think it just comes down to having been in the game for a while, you kind of know if you've been an investor, how often you like to hear. So I'm curious from your perspective, what is your LP communication philosophy, just especially during volatile cycles? Yeah.
So it starts with what the LP wants, right? So some of our LPs are like, I'll see you at your annual meeting. That's all I want to see. And some are like, I want to hear from you every quarter. And some are like, I want to hear from you every quarter, but I'm going to call you every once in a while. And we are fine with that. But I'm a big believer, right, from when I was running my family office and investing, that, right, good news walks down the street, bad news runs down the street, right? I want to tell, especially in volatile times, as you mentioned, my LPs are hearing about bad news much faster than they are hearing about good news. And not just this is the news, what the plan is to rectify it and what we're doing and how we're doing it. And sometimes it's out of your control. Like we had a business that was severely impacted by COVID, right? We lost 90% of our customers in a month because everything shut down. And we had to get on the phone with our LPs, explain, discuss what we were going to do, right? Built a plan. And we were able to save that company, and that company is going to be a longer hold than expected, but is now doing, more EBITDA than pre-COVID, and good news is good to deliver. Bad news is not so fun, but you have to do it sometimes, and you have to deliver that news faster. So we start with the base case. How often do you want to be, communicated from? And even the ones who say, I just want to see you at the annual meeting, they will get our quarterly letters or monthly letters and things of that nature. They're not going to read them, but they're going to get them. But so we start with, what do you want? How often do you want to hear? What's the cadence you want? What do you want to hear? What's the information do you want to hear? How do you want it presented? How do you want us to communicate with you? And we will follow that template. And then if something happens in between that we think is important, like the acquisition of a company, the sale of a company, or bad news at one of the portfolio companies, we will, communicate that quickly, efficiently, and like I said, with a plan to rectify if there's an issue.
Got it. I've asked myself this many times, and so I'm going to ask you the same question. So if you're starting over today with $0, but you did have the AUA playbook in your head, how would you rebuild from zero in 2026?
I would start with, the reputation I had built, the relationships I have, the results I've built, and try and leverage that with investors. I would try and build that with people that I know who can invest, and ideally have a deal that I can build a fund around. That's actually how we did it when we started, me, Steve, Dave, and Kais. We found a deal that we thought we could build a fund around. And that's how a lot of emerging managers and first-time managers do it, right? Prove you can do what you say. And that's how I would do it. But it's difficult. And, times are different. The world just moves faster and faster every day. Yeah. But definitely I would stick to what I know best, what I've been successful at. And if I can find a deal or maybe even two to coalesce around and get people excited around, that would be the way I would do it.
So start with the 3 R's. We have been hanging out. Yeah. So reputation, relationship, and results. I always say those are your most valuable assets in your possession, whether at zero AUM or $1 billion plus AUM. That never stops being valuable. And so, like your reputation, that's vital. Relationships and results. And really what it comes down to is building trust. And I always say high finance is more about trust than transactions. Yes, obviously both need to be there. You're not going to raise anything if people don't trust you. If you have a bad reputation or horrible relationships, or bad result, right? So those three really come together to say, as an LP or an allocator into a fund or to a fund manager, is to say, what's your reputation like? Are they easy to work with? But that's not just investors. That's also people that you invest in. Your PortCos. They could say, I've heard you guys are jerks and you're horrible to deal with, which you're not. You guys aren't. But if hypothetically that scenario pops up with anybody, you could say, yeah, okay, you got great results, you make money, but I heard I'm going to sell to someone who's not going to make my life hell. Like your great story about Peter Lee, where he was like, yeah, I gave up control, but I never felt controlled. So it was a great experience. It was a great result for him.
Yeah. And look, one of our biggest tools in our playbook, in our toolkit, I should say, when we talk to families about partnering with us, is simple, right? And it gets easier every time, is I say, look, these are the families we worked in the past. I can introduce you to them, or you can cold call them and ask them what it's like working with us, whether we've sold the business or still partners with us. That's important to us. And like I said, that's why it's also important for us to make sure these businesses do well after we sell them, right? That we are building better businesses so that the next person can just click and play and take it to the next level. I know what we're good at. We're good at taking from here to here and let somebody else take it to the next place. But that ability to open up our portfolio and say, call any family member of any company and ask them what it's like to work with. And look, some people don't like when I tell this story, but as I mentioned to you, every every family that we've sold the business for has become an investor in our fund. And that includes the patriarch of one family that we had to fire, right? So he was CEO of business. We had done some tuck-in acquisitions. The business outgrew what we felt he was capable of running. The business had come stagnant. He wasn't happy when we told him he had to leave. We sold that business to Cirque du Soleil, and it was a good exit. And he became an investor in the next fund, Fund 2, and investor in Fund 3. And we have a great relationship with him. And he talks to us all the time about how he can be helpful and how we can activate him in other portfolio companies. And we're trying to find ways where he can sit on boards, right? That's the type of person where some people will say, that's not a good outcome. You fired him. I was like, talk to him, see what it's like, right? We had a plan. Sometimes plans don't work out as you want, but it's how you treat people with respect. And in those times that are not going great, and they'll understand.
Yeah. I love that, man. That's a great story. I'm so glad you told that story. It was really good. So before we wrap things up, is there anything else you'd like our listeners around the world to know? Maybe where to go if they want to learn more about what you're up to at AUA? Anything at all? Yeah,
look, you can go to our website, and obviously, hopefully, listening to your podcast, as so many do, will inspire them to go to the website. Just follow I write some articles here and there, and just get activated in this universe. It's made me so happy being able to work with families. I love the families I work with. I often say I have two families, a family of chance and a family of choice. And my current partners are my family of choice. My friends are my family of choice. And I'm blessed to have two great families like that. And my current partners aren't just, Steve, Dave, and Kais, but it's all the families that we are in partnership with, the ones we've worked with and sold, and the ones who are investors. I've been very fortunate and very grateful, and I thank my parents and my siblings for helping along the way, and all my friends, and couldn't be happier for where I am, and very blessed and grateful to God for where we are.
Yeah. Awesome, man. Well, thank you. It's your heart is in the right place as always, man. So, just to summarize everything that Andy and I spoke about. So, seek alignment with your operators, both operating inside of your fund as well as your PortCos. The other one is pay attention to leverage. Not that you're not, but make sure that you understand not just do we need leverage or not, but what is conservative, what is aggressive, high rate environments, those things can change. And then ultimately invest in your 3 R's, which is your reputation, your relationships, and your results. You do these things and you too will be well on your way in your pursuit of making billions.